time for a global money talk. Everyone's eager to earn an income, yet merely harboring the desire for wealth without reflecting on the diverse attributes and nuances money carries offers little practical benefit.
Sure, but when it comes to investing, I'd like to connect more with the American scene rather than the other scenes. What unfolds in the US while the rest of us sleep sways every corner of dynamic global capital markets, so I felt compelled to bring an American scene into our discussion today.
Today's guest has amassed experience not only as a seasoned financial journalist reporting on markets daily, but also as a professional at Bridgewater, a premier hedge fund already well known to our audience.
Ray Dalio?
Today, we have the pleasure of welcoming an author who has first-hand experience collaborating side by side with Ray Dalio. Let us introduce Mr. Paul Podolsky, esteemed author of the acclaimed book, The Uncomfortable Truth About Money. Hello.
Welcome. Mr. Podolsky, could you please briefly introduce yourself to our audience?
Oh, sure. So first of all, thank you for having me on your show. My name is Paul Podolsky. I am the author of The Uncomfortable Truth About Money. I am the founder and the Chief Investment Officer of K Capital. And for many years, I worked at Bridgewater Associates.
You know, to be honest, we just haven't been sleeping all that soundly of late. Each evening, fresh headlines flow out of the United States, and they shake the capital market so violently that we find ourselves clinging to every last word for guidance and reassurance. Despite the market rally, the U.S. market is still quite turbulent lately. How would you describe mood now?
You're right. This is a very risky time, and one where wealth is extremely unstable. And it's precisely the type of environment that I was thinking about when I wrote The Uncomfortable Truth About Money, which is that money is something that affects all of us. Some people like to talk about it. Some people don't like to talk about it. But particularly at moments of turbulence, understanding basic relationships with money is critical.
So, taking into account the pronounced upticking turbulence we've witnessed across recent sessions now, from your perspective, which uncomfortable truth about money are people right now most prone to misunderstanding, overlooking, or denying?
That it's stable. This is the comment, that money is stable. So every form of money, a stock, which is an ownership in a company, bond, which is a loan, real estate, currency, I think we wish that it was all stable, but the reality is that it's unstable. When we get moments of turbulence, that becomes very clear.
What exactly is that sense of something feeling stable? I mean, I want to have money. I definitely have that feeling, but the idea that money is stable or that it's unstable, why is this concept so important when we think about money? After all, if you glance at the book's original US edition, you'll see its title is The Inconvenient Truth About Money, which makes the point clear. Then why exactly does the inherent instability of money qualify as such a deeply uncomfortable truth?
We all want it because money provides security. But I think it's important to have an accurate understanding of money the same way you might have an accurate understanding of basic first aid or nutrition, even if you're not a medical expert or you're not a nutritionist. And the key thing is to break money into smaller pieces that you can understand, but realize that all of them, the value of a stock or the value of real estate, they're constantly shifting. And the only way to get comfortable with the volatility, for me, is to understand why the prices keep shifting.
So does listening to you today mean we can become rich?
I think it is possible to become rich, but you need to study very carefully how the system works and break the components of being rich into different elements. So first of all is, how do you generate income? That relates to how the economy is changing and what industries generate income over time. What was profitable 30 years ago will not be profitable now, and it might not be profitable in 30 years. So one part of this is understanding income. And then there's another key issue to being rich, which is understanding how to invest. It's very hard to earn money in the first place. And then the second thing is how do you save money? For instance, many of the companies that I've worked with over my career no longer exist or do not exist in the same health that they once were. This is actually normal. So how you're generating your income is shifting all the time. And then the investments that were safe 5 years ago are very different than the investments that are safe today.
Perhaps this veers into more technical territory, yet when we focus on the various functions and influence that money exercises in our lives, observing shifts in the US financial markets, along with President Trump's high-profile moves, we sense rising unease among investors over the escalating burden of dollar-denominated debt. Given those factors, do you anticipate that the function of money might shift, and that the US dollar's role as the world's main reserve currency could also change over the coming decade?
I do. I think that we're in the very early stages of the popping of a dollar bubble. So there's been a huge inflow of foreign capital to the United States over time. Much of it from Asia. And now you see a very substantial shift in U.S. policy that is protectionist and is also questioning the security alliances that the U.S. has maintained for 80 years, on top of which U.S. stocks are very expensive. So this combination of forces is leading to a change in the dollar's value that I think can continue.
Given your earlier point, if the stature of the US dollar is indeed in flux, do you anticipate we'll have to build our net worth through a broader mix of instruments, perhaps commodities, foreign equities, or other stores of value, rather than the usual dollar-based holdings?
Yes, it is. I think it's a meaningful shift that's going on in the world. And if I were a Korean investor, I would be considering diversifying my savings away from the United States.
Wow, it's honestly pretty terrifying to hear an American expert suggest that we ought to steer clear of the US market altogether. Given the potential uncertainty in today's markets, which core investment principles ought people adhere to in order to steward their finances wisely?
That's a big question. But first thing is keep it simple. Second thing is never invest in anything that you don't understand. And the third thing is break the investment into parts that you can understand. So, for instance, investing in U.S. stocks, there's three moving parts to their investment. There's the currency, there is the price at which they're paying earnings for, the PE, and then there's the earnings themselves. And you can think about all of those things 6 months or 12 months forward. So the key thing is when you're investing is to understand what's in the investments. And it's not that complicated to understand. In the book, I wrote down the basic moving parts in a stock, in bonds, in real estate, so that people could understand that if they don't already.
So people love investing in US stocks, but what I'm hearing from you is that even if stock prices rise, if the value of the dollar falls, investors might not see much of a return. So you're essentially warning us not to jump in blindly. Is that a correct understanding?
Correct. Don't blindly invest in anything, because it and not only could the dollar go down, but it's also true that earnings could go down if the economy is weakening as a result of protection. So when I started investing, I really didn't know anything in my 20s, and I gradually learned. But the important thing for Korean investors to know is that it can be learned. It's not that complicated. And just stick with those principles. Don't invest in anything that you don't understand. And to understand, break a stock or a bond or real estate into its moving parts. A bond, for instance, is just a loan. Like a government bond is loaning money to the government. And just like a stock has the price earnings ratio or the earnings, just two parts to it, a bond also has two parts to it. It has what the yield, what the real return is, and an expectation of inflation. That's it. And so you could understand a bond in terms of those moving parts, and then begin to think about, if you're lending money to the government, is it an attractive time? In other words, you're buying a bond. It is an attractive time to do that or not. Sometimes it is, sometimes it isn't.
It looks like we need to watch where the balance of power in the markets is tilting, put differently, which channels the capital is streaming into, and position our portfolios accordingly. With that in mind, Mr. Podolsky, where do you think those money currents are headed right now and next?
I think that the locus of power is different than the money flow, but basically many countries have been exporting a huge amount of their savings to the United States. And what this means is, if Korea and Japan and Europe just export slightly less of their savings to the United States, the dollar will go down. So I think the flow of money is staying at home, and it's less global flows of capital. So those places that are big savers will see their currencies go up, and those people that are big borrowers will see their currencies go down. It doesn't always work like that, but it's working like that right now, I believe. In terms of power, global power is shifting now. And this is why it's such a dangerous time right now. We have hot wars in Europe and in the Middle East, and much of these hot wars have to do with the question of who is going to be the great power. The enormous risk to the world, which I hope does not happen, is that there was a hot war in Asia as well.
I absolutely concur with your point. Imagine, for instance, a severe geopolitical tremor in Asia, say China launching an assault on Taiwan, which would surely be catastrophic. Still, all these headlines are in our faces, and like you said before, the wisest move is to put money into what we understand. You gave examples on approaching stocks and bonds. You mentioned things like that, but I'm not entirely sure what knowing something really means in this context. So, what exactly are we supposed to know? Yeah, we already understand what stocks and bonds are. Yeah, you also brought up things like figuring out the perfect moment to loan money to a country or government. Could you break that down in simpler everyday language so the rest of us can really get the gist of it?
So in terms of understanding the moving parts, for instance, and I explained this in the book, but for instance, the first time that I bought real estate, I didn't understand how real estate works. Real estate is also basically just like a bond. It's not something separate. So if, for instance, interest rates fall and it's cheaper to borrow, real estate prices generally rise, just like a bond. And if interest rates rise because it gets more expensive to borrow, real estate prices generally fall. And so when I was buying my first house for my family, I thought that real estate was something totally separate from what anything else I was. But as I understood it with time, you could begin to see that it was actually very similar. And then that helps let you know when it's a good time or a bad time to buy real estate. A lot of it has to do with what interest rates there are. When is it a good time to lend to the government? It's a good time to buy a bond and lend to the government, and there's different types of bonds, when the interest rates are high, which means they're discounting very strong growth. But growth is going to be weak. When you get those differences between high interest rates but weak growth, that's generally a very good time to buy government bonds.
As you laid out, it really comes off as though the optimal moment to scoop up bonds is right before interest rates begin their drift lower across the market. So if I follow, we ought to buy bonds when we foresee their prices climbing. Then once interest rates start sliding, extra cash sloshes through the system, and that, in theory, lifts the value of most assets. In short, it feels like the real guidance is to load up on investments just as rates look poised to drop. The catch is, nailing future rate moves with certainty is tough.
That's the Fed's job, isn't it?
Since the Fed ultimately steers the money supply, how on earth are we supposed to analyze, anticipate, or even forecast what it's going to do at any given moment? It's not like we can just guess blindly. So I'd like to ask, how should we go about studying this?
Well, it depends how you want to invest. There's different ways of investing, and you have to find the way that is right for you. If you're very busy running the program that you're running, you don't have time to think about what the Fed is going to do. So then you just need to have a very diversified portfolio. A, you need to get the highest income you can. B, you need to spend less than you earn. And C, you need to invest in a very diversified portfolio globally. Don't put it all in the United States. Spread it among stocks and bonds and make sure it's global. That's for most people what the best thing to do is. But for people who are interested in trying to time when to buy a stock or a bond, it's very difficult to do, because if you're good at it, it's very profitable. So it's very competitive.
Honestly, I have to admit that everything you're explaining really does add up. But for investors who are eager to get high returns and impatiently waiting for steady gains, it might all come across as rather abstract. Whenever you've introduced these concepts to fellow retail investors, how do they usually respond to what you're saying in those conversations?
Since publishing the book, so the fund I run, K Capital, it's for institutional investors. It's not for individuals. So I don't give advice to individuals. But people who have read the book, what they tell me is it helped them understand how money works. Because rather than be a textbook, which is kind of hard to read, it conveys the lessons I learned about money as I learned them. And that way it makes these lessons much simpler to understand and easier to understand. And so the response I've gotten from people who've read the book is it helped make a topic that's not always so interesting, both interesting and understandable.
Book readers who've already gone through your book will get your point right away, but for those yet to pick it up, could you walk us through a concrete example from its pages that maps the money flow so they can grasp just really how captivating it is?
When I joined Bridgewater, which is now the biggest hedge fund in the world, they forced us all to sit down and take a course. The course was 1 year long, and a lot of people failed it. And in this course, they went through every single investment, and they forced you to get familiar enough with that investment that you could explain it in terms of these basic building blocks, and about the way a stock works, the way a bond works, the way currency works, the way real estate works, the way commodities work. And for me, this was incredibly useful because most people say, well, at least in America, many people say, put all your money in the stock market. But this is terrible advice. The stock market can have huge declines. It has a gigantic impact on your wealth, because once your wealth starts to shrink, it makes it much harder to earn it back. So the power of Bridgewater was explaining to me how all these different assets work and how bad the losses in any individual asset could be. In the Great Depression, when my dad was a small boy, stocks lost 90% of their value. So knowing this history and knowing how these individual markets work, for me, helped me understand how risky any individual investment can be.
Right. After all, if a stock loses 90% of its value, it needs to increase tenfold just to break even. So when I look at traditional diversification assets like stocks and bonds, it used to be that when stocks fell, bonds wouldn't fall as much. But lately, that relationship seems to have changed. They've been dropping in tandem. You recall that in the surge of inflation, both equity markets and bond prices sank sharply, meaning that even investors who believed they were diversified had no choice but to watch their portfolios contract. We feels like the same pattern is going to happen in the future, and that makes it challenging to decide what a reasonable diversification strategy should be right now. How do you view the current situation we're in?
Yeah, I think that that's right. That it is a very difficult time to find safe investments now. And so you really face a choice, which is that over long periods of time, diversified portfolios will outperform cash because that's the way capitalism works. But at moments in time, cash can outperform all of those investments. Now, picking what those moments of time are very difficult. Other assets, gold, foreign currencies, they've been gaining in value, but those are not traditional assets that people save in. I wrote the book because a lot of times people give very simple formulas. Just do this with your money. It sounds nice, but none of those simple formulas are 100% reliable. So I wanted to explain to people what I've learned about money to allow them to make their own choices.
If I'm being completely candid, the highly aggressive investors could perceive what you're proposing at first glance as somewhat discouraging and even a touch exasperating. Whenever you recommend sticking with a long-term horizon and staying diversified, it leaves us uneasy since we have no idea how many years that approach could take. Plus, institutional players seem to rely on leverage, borrowing to pump up their bets, right? So suppose we deliberately dial back our expected rate of return, aiming for something a bit more modest. In that scenario, couldn't we make up the shortfall by applying leverage? That is, by borrowing capital to boost our position. In practical terms, how should an investor frame the use of debt within a portfolio?
It's just a tool. It's a tool like electricity. So if you use electricity well, we could have a conversation like the one we're having. But if you put your finger in the light socket, you'll die. So leverage is just a tool in investing, and I use it when I invest, but you must understand it.
So what is the right way to use debt? To use it as a tool? How should one approach that? And that's just how you wind up falling into a trap.
Exactly. Think about electricity, for instance. There are printed guides describing how to use it safely. If you carelessly jab a fork into a socket, you'll end up shocking yourself. So we'd really like a clearer, more specific explanation from you.
So I'll give you two examples. The first is when you're buying a home. Most people don't have, at least for the first home, enough cash to buy the home. So they need to borrow money to buy the home. So that is a use of leverage. And it can be good, but I think the key thing to recognize is that you don't want to take on so much leverage that if the home loses value, you all of a sudden have no money. So for instance, if you put 50% down on the home and borrow 50%, the home can fall by 25% and you still have equity in the home. But if you borrow 95% and you only have 5% equity in the home, and the home falls just 5%, you've lost all your equity. So knowing this is important. Another example is you might see a bond, a short-term bond, that is not very volatile, but you want to make it so it has the similar risk of stocks. You could add leverage to the bond, or you could add cash to the stocks to make them less risky. So it's just a tool.
With the market could be so unpredictably unstable. While I was rereading your insightful book, Mr. Podolsky, that particular chapter on how to deal with volatility and uncertainty genuinely resonated with me so deeply. Given that today's world is being relentlessly pounded by unprecedented bouts of volatility and uncertainty, I'd much value hearing your candid, first-hand guidance on the practical steps we should all be taking right now to navigate it.
I think volatility makes us anxious. At least it makes me anxious. When stock markets fall sharply or the currency moves sharply. So the thing for me is two things. A, mechanically understand why the stock market could fall. The PE on the US, the price to earnings ratio on the US stock market, in a recession, it can fall to 15. So if the stock market falls 25% from here, that's normal. So A is understanding how the prices can change, and B is understanding how much they can change. It's like dealing with bad weather. Like, we've all been caught in a snowstorm, but you know that snowstorms can happen. A really bad snowstorm might last 2 days, but you know that it exists. And so once your expectations adjust to how big the extreme can be, how hot it can be, how cold it can be, you can do the same thing for money. And then you understand why it's doing what it's doing. And then you're less anxious because you understand what you're dealing with.
It appears you keep circling back to this core idea of fundamentally knowing something. I imagine that's because when a market storm suddenly breaks, you must grasp the situation well enough to choose confidently between buying in or backing out. Still, if we linger on this notion of knowing, it's plain that economists don't automatically grow rich from their own investing. Take me, for instance. I'm an industry-focused journalist, skilled at spotting trends and market shifts, yet when it comes to my portfolio, I'm far from an investor. Then within this overarching idea of knowing, I'm curious what you see as the single most pivotal element that truly distinguishes investors who prosper from those who fall short.
Imagination. So there's again, for most people, spend less than you earn, save money. That's the best thing. Don't try to time the market. But in terms of investors that are fantastic, they have imagination. And they can see a future that hasn't yet occurred. And it's rare. It's a combination of the left brain and the right brain. The left brain is analytical. Part of investing is analytical. You need to know what the bond yield is, what the PE is, what expected earnings are, what the currency is, what forwards are, what options are. All that's very analytical. But the best investors are also highly creative, like a painter. And they can paint an image in their mind of what will the future look like that hasn't yet occurred. So we were talking earlier on the call about a world where the dollar is no longer the dominant currency in the world. That's a different picture.
I was genuinely blown away as I made my way through your book. I picked it up thinking I'd gain simple investment insights, yet out of nowhere you emphasize how crucial it is to navigate office politics well. So even while the cover promises an investment manual, every chapter brims with life lessons throughout. Then, what makes you spotlight those life lessons alongside the investment tactics intended for people looking to build substantial wealth?
Because it matters. So the first part of the book, as you know, is about generating income. And most people think about this in a very dry way. Like, an economist gets paid this, a trader gets paid that, a doctor gets paid this, a secretary gets paid that. But in my experience, that's not how it actually works. That once you get into an organization, you're an engineer or a doctor or you're in media, there's a whole separate game that starts about how to improve your income within the organization. And office politics matters a lot. And I didn't find anybody talked about this. But in my own life, in all the organizations I was with, office politics were critical. And so this is what I was trying to do with the book, is give real life examples of how it works. And I also wanted to make a point, like, money is really important, but it's not the most important thing. The most important thing is doing what we're doing right now, having a conversation, spending time with people. That's more important than money. So I wanted to make sure the money book reflected that truth as well.
Well, today we've been talking about money, and with Mr. Paul, author of The Uncomfortable Truth About Money. He is the founder and CIO of Kate Capital. While turning each page of this thought-provoking volume, I realized more and more that it is far from being a mere step-by-step handbook for padding your bank account. Instead, it revealed itself to me as a deeply insightful yet remarkably approachable narrative on how to steward and grow one's resources over the entire span of a lifetime. I trust these insights will prove valuable to many people as they steer through the various stages of life.
This has truly been an extraordinary chance to absorb such detailed and, at times, deeply personal narratives from an authentic authority.
Time to say goodbye to our guest author, Paul Podolsky. We'll need to bring our talk to a close very soon. Thank you to everyone for joining us.